any consumer, those in poverty might make the switch to digital finance when it makes their lives easier, is more convenient, adds value, and when they trust the service. And digital finance, when operating in an enabling environment, can lower costs and increase speed, transparency, security, and availability of more tailored financial services. And this has already been helping to reach more and more underserved adults at scale and encouraging a global shift from cash to digital finance, promoting financial inclusion. And by enabling environment, I mean places where the basic enablers for digital finance help to make digital finance more attractive than cash. And the FIGI Symposium will touch on many of these enablers, including the need to strengthen ICT and payment infrastructures, foster the development of ID, ensure policies that enable access to electronic money services, among many other enablers. In terms of the needs specifically of underserved consumers, poor and marginalized populations do have their own set of unique needs. And with any new service, DFS comes with its own unique challenges. For example, in some countries, the expansion of DFS has caused the gender gap to actually widen. In addition, in other countries, consumers who have less access to technology, less connectivity, or less familiarity and comfort with tech products, including older populations in particular, may find DFS difficult to access and use sometimes. So a push in design and new ways of leveraging data can help to customize digital financial services to better meet these unique needs of underserved consumers and make DFS more attractive. Using behavioral insights as well can help develop consumer-centric products and help consumers overcome specific obstacles. But the availability of digital financial services by itself is not enough. You also need responsible financial inclusion policies and practices to help consumers trust in the service and make the shift from cash to digital finance. Newly banked consumers, for example, might not always be familiar with using a financial product, let alone a smartphone. And in some cases, they might have to navigate sales tactics and fees and charges and terms and conditions all over the phone or online. And this can cause them sometimes to take products that might not be well suited to their needs or lose trust and turn away from the formal financial sector, depending on their understanding. So consumer protections alongside digital financial services is really important to make sure that customers are, for example, given clear and comprehensive information, are protected from unfair and abusive practices, and can easily resolve conflicts. This will help increase our trust in digital financial services more broadly. And financial education as well, when done right, can also help consumers mitigate risks and become more confident from shifting to cash to digital finance. Financial education can help consumers, particularly underserved and newly banked consumers, understand, access, and appropriately use financial services in digital finance and mitigate financial risks. One of a consumer's best defenses against financial risks and abuse is their own full knowledge of a financial product or service and its implications at the moment of making a financial decision. So financial sector authorities do have a clear financial education role to play, particularly when financial risks are posed to consumers. And while consumer protection regimes also focus on mitigating core risks posed to consumers, financial education can play an important role to complement these consumer protection efforts. And there are many impactful roles that policymakers can play. For instance, building partnerships, particularly with other government institutions, to embed financial education into programs offering financial services at scale. For instance, these would look like cash transfer programs, agricultural lending programs, pension programs, among others. When underpinned by appropriate designs to make financial education more impactful, along with proper coordination, for instance, coordinating with consumer groups, piloting, monitoring, and evaluation, policymakers can play a key role to help consumers become more financially capable to access, use, and mitigate risks of finance. So I think mitigating core risks should always remain a central focus of an authority's financial education approach and the cornerstone of their role in order to help prioritize their efforts and keep them focused and impactful and improve consumers' ability to mitigate risks more broadly. So this is the third and final FIGI Symposium, marking the completion of the program. My hope is that policymakers are able to draw from the symposium and the lessons from FIGI and gain new methodologies, tools, and expertise to support their efforts in building the basic enablers for digital finance. The symposium will provide new solutions for authorities to better supervise and monitor DFS as well. For instance, the symposium discusses quite extensively the need for cybersecurity, Another major theme is a focus on closing the gender gap and increasing representation of women leaders in digital finance. And the symposium also underscores throughout all sessions the importance of collaboration between financial and ICT sectors to increase financial inclusion. So my hope is that this event will provide policymakers and practitioners with a productive forum that will help them scale up DFS and financial inclusion globally.